dive deeper into the world of CVCs.
Thank you, Partha, and thank you, the Venture Now team here for inviting me and also allowing me to discuss a bit more about the corporate venture capital and how this asset class is now rising as a startup financing mechanism and what lies ahead, at least for the CVCs in India, and how they can leverage the ecosystem to their own corporate benefit as well as make this ecosystem more robust. So I have a presentation with me. I'll quickly go through that. The agenda is to go through some of the high level items around how CVCs are engaging globally and which are the top CVCs engaging at least on the automotive front, and also touch upon some of the CVCs which are now becoming active on the energy. These are two areas where Cummins India Limited is primarily focused on, and the Cummins CVC is also looking at. And apart from energy and automotive, there are n number of areas where CVCs are becoming active. So I'll cite those examples. People can take a note of them and probably find out the right and relevant partners at respective CVC organizations. So I'll quickly go into the presentations. Feel free to share your questions so that we can engage probably at the end of the presentations and also see if it is possible for us to find any avenues of collaboration as well. Can I get the share screening rights? Let me know if the presentation is visible.
Yes, we can see it.
So today we are going to discuss a broad theme around corporate venture capital, how this particular segment of asset financing has come up, and which are the major organizations from its history that are responsible for creating or maturing this asset class. CVCs is not a very, I would say, new segment, but there have been multiple players previously which have been responsible for adding, you can say, CVC as a theme for their organization, like Nokia. Nokia had Nokia Growth Partners. Similarly, TDK Corporation recently had launched out TDK Ventures, which is focusing on the semiconductors. So there have been players which are doing CVC for almost 15 to 20 odd years, and then there are a few players which are doing this for last 4 5 years. Looking at the Cummins history, they have been doing this for the last decade or so, and they have been largely focusing on the US and EU geographies. India is more of a nascent market for them, and they have been focusing again on new age energy resources, especially hydrogen, component manufacturing, and software play. So these are the three areas of focus broadly where Cummins is interested in. And looking at the other CVCs, there have been a few recent launches of CVCs like Schneider Electric, which has recently launched out its India partnership team. And similarly, there have been some interest from the global CVCs like Shell, which is looking at oil and gas sector to invest into India market, and they have a very good portfolio looking at Indian odd startups. So now coming to what exactly CVC is, corporate venture capital. So I'll quickly go into the academic definition of that. Uh, while looking at CVCs, one should not only associate that it is a way for a corporate to invest directly into the finance. There are multiple avenues for investing into finance for the startups. When you're looking at the overall venture ecosystem, why CVCs are important, so I'll highlight the reason broadly for that. In India, the early stage ecosystem and the growth stage ecosystem are well capitalized. There are mature players in that, and they have been financing the startup for almost 15 odd years now, starting from 2007 and way beyond that. When you look at the early stage ecosystem, people who are writing down the pre-series A and the series A checks, they are quite a good number of players, and there have been multiple success stories out of that. Most notably, the likes of your India Chirate, Yornest, and Xfinity Venture Partner. These players are financing out the pre-series and the Series A kind of checks, at least in the deep tech ecosystem, where ClimateTech eventually falls. Now, coming to the growth stage, some of the companies which have shown promise, they have been able to raise the growth capital from the marquee investors like Axel, Sequoia, your Tiger Global. These are the global franchises of the funds which are already operating in the US and European Union markets. Though we do not see a growth stage investor with Indian roots right now, but there are higher chances that growth stage startups will come into picture. Sorry, financing firms will come into picture depending on the number of exits and how robust the ecosystem will become over a period of time. Now, coming to corporates, why corporates are needed in this ecosystem? They are primarily a vehicle which can help on the growth stage and the late stage side of things. Because in India, what we see is the growth stage financing and late stage financing is missing, and there needs to be more number of players which need to get added because eventually at the end of the day, there needs to be a subsequent end user of that technology as well as the players who can scale those technologies to global markets. Either this can be done via the domestic capital or you need institutional capital coming in from the wide variety of sources. That's how the corporate investors will be looking at the growth stage and late stage investments. One more thing to add is the Indian ecosystem right now is limited by the number of M&As, the number of mergers and acquisitions which are happening at this point of time. It also limits down the number of exits where the VC funds are able to realize returns from their overall deployed capital. So, because of that issue, the global players are more or less the right avenues for the startups to get the growth stage financing. But whenever an exit will happen, there will be more number of growth stage firms or late stage firms which will get created. So till that time, the corporate investors will have an active role to play in this market, and they will also contribute to maturing this ecosystem going forward. If there are questions, please feel free to barge in. Now, coming to the academic definition of a CVC, CVCs are generally corporates which are directly involved in investing into the startup communities, and also they take out the minority equity stakes, followed by an approach to realize financial and strategic gains. Most of the time, CVCs are looking at strategic returns rather than the financial returns. That's the core USP of getting a corporate investor to look at it. But off late, some of the CVCs are now becoming more interested toward the financial returns, the number of money multiples which a corporate investor can realize over a period of time. So the mandates change from time and again. Looking at the CVC engagement model, they are somewhat different from the venture capital funds, but when we look at the CVCs, they generally are not only deploying their capital, but they are also looking at alignment on the strategic goals as well as finding out common interest with the parent corporation. So that happens with the likes of your Googles, your Amazon SMB fund, and similarly, even the likes of us, which are investing into energy and auto stocks, we are also looking at alignment on the strategic goal, which is serving out our end users. So that's how CVCs are different from a VC. And the benefits of CVCs are multifold, but largely these fall into the two set of buckets. One is patient capital, access to, you can say, quality resources early on, because as an early stage startup, you do not have access to quality engineers and large corporates with ample amount of capital. They are in good place and shape to acquire as well as invest into people who are interested into, you can say, developing new age technologies. Plus, CVCs also have a very strong access to market when it comes to selling out the products in the global arena. And this has been the case with major corporates like us, your ventures supported by Shell, Schneider Electric, TDK Corporation. All these large CVCs are following the same approach. Now, looking at CVC as a strategic tool for the startups, this CVC is more like a tool engagement for the large corporates as well as the leadership, while making it more accessible for the leadership at the corporates to engage with the startup in a more structured way. So it offers multiple set of strengths, weakness, as well as some form of issues going forward. So I'll highlight the strengths first. Uh, when it comes to CVCs, it's largely an access to innovative technology as well as potential partnerships with the startups, which is missing in the early ecosystem for large corporates. That's the plus point of having a CVC, which helps you manage those relationships better and in a structured way, because you hire out dedicated investment professionals as well as uh, innovation professionals who are largely responsible for running those engagements on a day-to-day basis. There's one weakness when it comes to managing out the engagement is these engagements sometimes have short-sightedness where the CVC can only look out for short-term gains out of the engagement without looking at the long-term investment horizon where the multiple returns could be realized on money multiples. So sometimes these CVCs have that weakness where they do not understand that. Then comes the opportunities. The CVCs are a way for the large corporates to create a innovation strategy and also sometimes house the CIO office, the Chief Innovation Officer office under this particular venture. This sometimes offers competitive advantage as well, but it may not be a guarantee for them. You can understand this with the likes of Kodak. They had a venture investment arm, but they were not able to make themselves competitive over a period of time and save themselves from the issue. And the same applies for Nokia as well. They had Nokia growth partners, which obviously did not make them stay relevant in the market. So it's a mix of yes and no, where you can realize competitive advantage and you may not realize competitive advantage depending on the scenario which you are supporting in. Now, when you look at CVCs, CVCs may not be a right way for a corporate to adapt to the changing technology landscape. This can only be a supporting tool where one get access to the early stage startup ecosystem where they can collaborate and build products and sell in the market, but it cannot guarantee returns over a sustained period of time. It can be a momentary thing for them, like a 12, 24-month cycle where they will be able to realize good returns. But from a long term strategy, they miss out a lot of these opportunities over a period of time. This has happened with the major CVCs. If you recall, the recent GPU and the DPU boom, where the likes of NVIDIA have been able to realize more access to, you can say, quality products, leaving the other chipset manufacturers way behind, especially in their valuation as well as the kind of revenue growth which they have been able to realize. So those kind of disruptions or large market scaling cannot be ciphered out by the startups. So that's why CVC is just a tool. It is a way for them to collaborate, but it cannot get you to a certain scale which helps you increase up your revenue. Hope everyone is aligned on this. Now, looking at how different leadership teams are able to create a catalyst for innovation, it's largely a case of three things. One is the strategic alignment for the leadership. The corporates have to be aligned on how to use these investments from a long term approach, and they should more or less be aligned with the core business areas, which are dependent on the kind of business unit structures which one would have. Second is the risk return profile and giving access to people who are doing these day in and day out, like running up your innovation professionals or investment professionals. They should be able to uh, give them freedom of running these exercises on their own by providing them either independent pools of capital or provide them with independent decision making where you can collaborate with certain set of startups and those investment or innovation professionals can engage with the BUs directly. So these kind of structures need to be created out by the leadership then only the risk and return profile will be created for those kind of investment opportunities. Secondly, what I see is on a risk and return strategy, these are generally medium returns or mediocre returns when it comes to uh, large corporates collaborating, because most of the time the capex cycle or the capital expenditure cycle of the large corporates allows you to get certain returns in terms of product sales as well as hedging against the new age technology, at least at a annual level. So the risk and return profile generally for the corporates is moderate in nature. Uh, it may not have multiple returns like how VC would get, but the leadership should be aware how they should be leveraging this as a tool. Then comes cultural integration. Most of the time, startups have a young team, plus they are also following the philosophy of move quick and break things. So, using that philosophy, a lot of good things also happen, and sometimes it also acts as a deterrent for the large corporate to integrate them as a part of the overall corporate group. So, cultural integration definitely is a problem when it comes to corporates engaging out with the young startups. But when you look at the CVCs, the professionals who are working in the CVCs, they generally come up with a bend of mind that you have to manage those relationships as an engagement manager, as well as keep those engagements active for the corporate to take it forward. So cultural integration problem is left out of the way, where the CVCs act as the primary contact for the corporate to engage with the startups and also leave away this problem of cultural integration. Plus, it keeps a lot of, you can say, operational things at bay, which the corporate would be looking to avoid. Moving on. Now I'll talk about the different models of approaches which a CVC is generally using globally. So I'll cite some examples from the India market, how different venture funds are operating in. This is more of a market observation, not from a regional report or so. The first model of approach is standalone corporate innovation funds, where a pool of capital has been left aside to run these operations or investment activities directly. Then the second approach is corporate innovation fund along with an incubator, where the corporate will be involved in running up an incubator directly as well. The last bit is about the ecosystem play, where the presence is across the different value chain, right from your early stage ecosystem, your accelerators, incubators, followed by private equity or the late stage investing as well. So looking at the intensity, the first model of approach is more easier, more clean in terms of following. The middle model is something which requires a lot of people, a lot of resources to curate the startups and run those ecosystem directly. Then lastly, we are looking at ecosystem play. This is more comprehensive in nature. It requires obviously large pools of capital as well as manpower to run those. And there are very few examples which come under the ecosystem play. Now, looking at the standalone corporate innovation fund, uh, here the investment may or may not be aligned with the core business as a part of the corporate innovation program, because these standalone corporate innovation fund come with a mandate, whether they are either having a mandate to invest into the core business areas or not into the core business areas, depending on how the corporate group is looking at hedging the risk as well as diversifying the pool of capital. Some of the examples here are Marico. Marico has its own venture fund, Sharp Ventures. Shapoorji Pallonji has its own ventures under the Mystery Ventures name. And then you have Pidilite running up Pidilite Ventures, which is investing into home decor and allied products. Now, looking at the deal volume for such kind of players, these are generally medium in nature and less time intensive. That's why you require less number of resources to manage them, like 2 and 3 resources to look at the deal flow management, review, and execution. When we look at the corporate innovation funds along with the incubator, these are most commonly followed approaches where you get access to both early stage as well as the late stage ecosystem play. And Some of the global corporates which are running this are well known, like Shell. Shell has its own ventures arm as well as Shell E4 running out of Bangalore. Then we have the likes of Larsen and Toubro, which is a global group working in the infrastructure space. They also have their innovation fund as well as supporting activities with some of the incubator arms. Then we have the likes of Volvo Cars, which have their ventures as well as their incubator called Campex running out of Bangalore. The deal volume in this case is high. It is time intensive in nature because it involves a lot of deal scouting. Generally, I have seen the team structure to be around 4 to 5 resources with help in the deal flow management, review, and execution. Lastly, the ecosystem model is more of a holistic approach, which gives access to wide array of startups from the idea stage to the late stage. In India, Aditya Birla Group is following a very similar strategy. Lego in Denmark has a similar strategy. The deal volume is quite high because you're looking at idea stage to almost late stage startups. So obviously the deal volume is high, and most of these teams are broken into smaller units. That's why the number of manpower involved in this will be higher. Now, looking at those examples, I clearly cite here Aditya Birla Group to be present across all the ecosystem. You have an accelerator, you have a Atal Incubation Center as well as an incubator in terms of PITES, Corporate Innovation Fund running at central level in Aditya Birla Group, followed by private equity player. So it's a holistic approach which they are following, and it is distributed across the value chain. Uh, Again, these are not documented things, and these are my observations. So everyone is should be aware that you should apply discretion while using this as a part of their own thesis. Looking at the standalone corporate innovation fund, you are talking about Shapoorji Pallonji, Pidilite, Sharp Ventures to be active. Now, looking at this corporate innovation funds plus incubators, we see the likes of Campex working with Volvo, Larsen and Toubro having its own innovation factory where they have recently launched L&T EduTech. Shell Ventures has Shell E4. As a matter of fact, Cummins is also working with Shell E4. So we realize that having an incubator always helps when you are looking at the early stage ecosystem. So that's why more collaborations and more opportunities to participate in the ecosystem are needed. How a CVC would source out these deals. So these are some of the sources where a CVC would be trying to engage with the ecosystem. First is corporates, corporate innovation funds. Second is academia, research lab partnerships, where you sign up the premier institutions who are working in R&D space, who can provide access to the really transformative startups. Third avenue is incubators, accelerators, and platforms, which help you provide access to the deal sourcing from a very early stage standpoint. Fourth source is other VC and private equity firms, family offices, and wealth management institutions who are involved in the financial raise of all these startups so that you work with those investment bankers and participate in the exact deal making. The last two sources are around databases, hackathons, and industry forums. And lastly, the thought leadership and reputed agency reports, most notably your likes of CI, NASCOM, TIE Global, IVCA, Startup India as well. So those thought reports actually add a lot of value when it comes to CVCs engaging out with the ecosystem and creating out an idea hopper, which obviously boils down to some of the few resources which go to the top leadership. CVCs generally do not have an alternative investment fund structure, but there are certain regulations which allow you to participate as a limited partner in India, where you invest into funds which are directly involved in the dispersal of capital. But there are only a handful of organizations which are running up their own AIFs right now. And some of the corporate investors generally do the investments from the balance sheet. Cummins is also a balance sheet investor. It do not have a separate fund altogether. Under the SEBI guidelines, you had two set of frameworks, 1996 and 2012 framework, which generally provide guidelines for an AIF to structure. But I would like to cite how a CVC generally works when it comes to a CVC fund. You have a global corporate here, which does equity infusion into a CVC fund, and a CVC fund is responsible for infusing into the portfolio companies. once you realize capital gains from the portfolio companies, the money goes back to the fund and it eventually goes back to the corporation. So it creates a rolling pool of capital where you have access to that capital only once there are financial exits which one would require get access to, and they provide you with a evergreen kind of a fund where the money based on your own PNL, you can harvest those returns and give it back to the corporate, and the corporate will return those money depending on the economic scenario. So that's how a CVC structure works globally, at least for the balance sheet investors. And for the ones which are creating an AIF, the typical AIF norms will take into picture where you need to get registered with SEBI, you need to take their financial consultation while creating out its own memorandum and articles, followed by access to the public markets to get access to those other set of LPs. Looking at a case study in India, we have most notable example of InfoEdge, which is listed on Indian Stock Exchange with the name of Naukri. They have been able to realize good financial exits, at least from the Indian startup ecosystem, with Zomato and Policy Bazaar, where they held at least double-digit shareholding in those two companies, and they have been able to realize good returns over a period of time. But InfoEdge has a very strong track history of investing into these early companies where they created out almost 22 startups with good financial history over a period of last 15 odd years. The overall book size of these kind of startup investments run up to 520 crores. That's a very big number. When you look at a homegrown Indian enterprise which has invested into the Indian startups and created value for its own shareholders as well as for the shareholders at the corporate level. So that's a very remarkable case study, at least from a India homegrown organization. There are global organizations like that in Singapore, like Singtel and Temasek, but we obviously need to celebrate our homegrown winners for that. Now, looking at InfoEdge investee companies, we typically are looking at Shop Kirana, Shipsy, Gramophone, Adda 247, and Business. So these are some of the good run businesses which will be able to realize good financial exits for them probably in future. So there is a lot of you can say possibility of more multi-bagger exits going forward for them. Using this particular case study, they have been able to create two set of funds. That's also another success story coming out of there, where InfoEdge Ventures, which is a separate VC arm of the business, they already have two set of funds from where they are deploying capital. That is InfoEdge Ventures Fund 1 and Capital Fund 2, which is totally summing up to around $350 million. So that shows how much promise, once you realize exits, can lead you to realize more certain set of funds going forward. Again, the growth stories coming out of there are more or less aligned with the Fund 1. Like Business was a part of their Fund 1, where they did the capital investment. Shop Kirana again comes from their corporate investment. Genie Mode, Now Purchase, and Tartan, these are some success stories which they have done from their separate investment fund. Now coming at the fund which they launched as a JV with Temasek called Capital 2B. It is a $75 million deep tech IP patent led product fund, which has shown some initial, you can say, interest towards some mobility based startups, which is also a theme which is picking up right now in India as EV component as a landscape is maturing. So there will be good case studies coming out of that. So overall, I see that InfoEdge is a quite of a interesting story where they already have $425 million of fund or a asset under management, and they have a track history to support their overall growth going forward. Looking at some of the CVCs from the global corporates, these are some of the success stories which I have seen across the different sectors, as well as the size of their portfolios also varies depending on the nature of the sector. Like J Labs, it is run by Johnson & Johnson. Though Johnson & Johnson is a dilapidated or dilapidated brand right now, where their products, obviously because of the US FDA requirement, they are facing a lot of issues, but J Labs was one of the pioneers in terms of investments into life sciences, where they invested around $70 million into 9 portfolio firms. And these portfolio firms have done reasonably well in terms of realizing cash exits for J&J. Now, looking at the airline sector, Lufthansa had set up their Lufthansa Innovation Hub, where they have deployed around $625 million across 23 portfolio companies. Again, the range of solutions varies from travel apps to consumer services. Then you look at a EU-based bank called Rabobank. They have Rabobank Frontier Ventures, where they have deployed around $75 million in 14 firms. It is spread across agriculture, finance, and banking technology. So you again realize that the ticket size can vary depending on how much you want to deploy, but the nature of those sectors where you want to invest will more or less be aligned with the parent organization. Now, looking at a chemical company like BASF has an incubator called Chemovator, which has a fund size of around $350 million. Here, the nature of these investments is very capital intensive. That's why you see a large capital pool against a very small portfolio company where $315 million have been deployed across 13 portfolio almost $25 million of capital per investment. So it shows certain sectors are capital intensive, certain sectors are not capital intensive, and your thesis or the kind of startups which you're trying to invest will vary depending on the value chain which you're looking at. Now, looking at an automotive brand like Volvo, they have a incubator called Campex in India and also a Volvo Innovation Lab. They are running with Stanford University. With this particular mandate, they have been able to create certain technologies which are getting deployed at the parent organization on the autonomous vehicle front. So the use cases can vary, the capital use can vary depending on the stage, and how you want to manage your portfolio funds will also come in from the CVCs. Now, some of the examples which I wanted for people's benefit is when you're looking at global CVCs which are investing into automotive, there are three major buckets which I have looked at when it comes to automotive brand. There are some investors which are more keen on investing into software mobility applications. Then there are few which are interested in electric vehicles globally, followed by automotive majors which are interested in manufacturing. Looking at the software play, Samsung is one of the best players in terms of providing out access to mobility related solutions. Samsung Catalyst Fund, Samsung Automotive Innovation Fund, SoftBank, Amazon Climate Fund are also doing similar investment thesis, but these are global in nature, where the investment is directly coming in from the US. On the electric front, you have the likes of Manev, Tandem, Autotech Ventures, Frontinalis Ventures, and GM Ventures. GM Ventures has recently exited its portfolio, but they still continue to hold on to some of the portfolio firms. They are more interested toward the EV front. Automotive manufacturing, you have the likes of Jaguar, InMobi, BMW, the Renault, Nissan, Mitsubishi Consortium, and Toyota Ventures. Toyota Ventures has invested into engine organizations, engine manufacturing startups, which are working with hydrogen. So that's one of the USPs of working with the global CVCs, which gives you access to that kind of a capital pool, which is looking to deploy into new age areas. Now, looking at a CVC, these are like the chit sheet when it comes to asking the right questions to a CVC. A CVC can provide you capital, but the nature of that capital has to be decided by the startup founder, where you can look at equity versus debt, flexible financing options, the terms of those debt as well. Then we are looking at the global network, where you're talking about a lot of CVCs having access to EU, US, India corridor. So if a CVC is able to offer you access to global networks, which can help you sell in those markets, then it's a value add. So these points are more from a softer angle, where capital is not the only play where a CVC can help you. There are more avenues for you to grow with that organization. Some of the CVCs also have access to engineering talent and experts, and they can also give you a bank of hours. Some CVCs have created that structure You should check on that aspect. Then, fourth point is around public sector relations, access as a service provider, where some of these organizations have very good relations with the government personnel, how they are looking at managing those relations. So, if a major corporate is able to help you on the government relations, you should leverage it to your own benefit. Then you have access to, you can say, workshops, you can say new age technologies as well. So that's another USP. Then we are looking at one-on-one coaching, where senior leaders of those organizations are accessible. They can mentor out the startup founders more closely, as well as help them realize the benefits of running up a business profitably. Then you have the benefits of co-working or working spaces. Sometimes major corporates are able to pay your rent bill or maybe provide you with a free working space. As a matter of fact, a Bangalore-based CVC had launched its working workspace on 80 feet Kormangla Road. So I realized that sometimes these kind of benefits are also lucrative for attracting the right talent and also the right kind of startups to your enterprise. Uh, then comes the dedicated helpline support as an engagement managers. Sometimes the CVCs not only act as a capital pool provider, but they also act as an engagement manager, where you provide them right kind of access to people, not only at the corporate, but also within the corporate ecosystem. The last bit is about any form of a relationship with the value add partners or marketing agencies, which can help you get access to, you can say, extra avenues of growth. Like Amazon, they have access to cloud programs, but they also have access to a lot of these uh, startup events, which can help you market out your solutions better. Similarly, the likes of NVIDIA, NVIDIA obviously runs its own Inception program in India. They provide access you to the GPUs, but they also have access to the global uh, marketing events where you can showcase your products as a part of their own portfolio. So, looking at different avenues from a software angle will also help you pick the right CVC partner. I will close here. Maybe we can start with the questions which we have received from the audience as well as any other questions which we have.
Yes, thanks a lot, Ankit, for sharing all your insights. We'll take some time to compile all the questions we have received from the audience. And I also have a few questions as I was just, going through the presentation that you have had. And so some quick ones, Ankit. One is you mentioned that it sometimes depends on depending on the model that the CVC is, whether it's a corporate innovation fund or whether it's whether it's in combination with an incubator. So it also means a lot of resources, right? So how does one corporate go about setting up a CVC in the first place? Do you also work with other incubators, accelerators to figure out what works in terms of the strategic direction that you want to take as a corporate? Or do you also, do it completely in-house when you set up a CVC like this?
Whenever a CVC is trying to enter a market, it's always good to partner out with the incubators which have a track history of themselves, especially the ones which have delivered results for their own parent organization or any other allied corporates. Like for Cummins, we are looking at the likes of Shell E4, working out with Cummins corporate venture capital team. So we realize that there are good track history incubators which are already existing. Partnering out with them makes it more accessible. But obviously, you may not be able to find all kinds of startup which are you are looking at, because our mandate is across energy, auto, and software related play within the auto components as well as the power systems area. So you may not be able to get all kinds of startup from one incubator. So multi-incubator strategy could be deployed in depending on the number of case studies one is able to realize from the first. And doing it in-house sometimes is very cumbersome because you require more number of resources to manage those engagement directly. Sometimes it is very difficult to do that in-house. That's why you need external partners, uh, at least from my observation. But
Yeah,
there are
thanks,
some
Ankit.
benefits of running this internally as well. You get
Yeah.
access to early stage ecosystem. There are some good deals which can come to you at a lower valuation, and
Hmm.
obviously these things matter, at least from a financial return perspective.
Great, great. You mentioned in terms of the structure of the funding, right? From global to the fund that's deployed locally, and then it goes back to the parent company, and sometimes it happens from the balance sheet directly, right? So is there any kind of indication, like let's say a corporate wants to set up a CVC, how do they want to set up the fund size, or how do they decide on the fund size, if it's directly from the balance sheet?
Typically, it's an investment thesis driven
Hmm.
structure where one will be able to create an investment thesis depending on the number of areas which one is looking at. Like for us, we are looking at automotive components, EV as a practice, software. So depending on these kind of landscapes, the typical appetite will be of around 2 to 3 deals per sectors.
Hmm.
So if you have 4 5 areas, so you multiply those 4 5 areas with the number of deal appetites you have, then you multiply with the check size which you are comfortable. Like for pre-series A and series A, the typical check size will vary between $1 to $5 million. And if you are a corporate investor which is only looking to do pre-series to series A, then your check size will be almost $5 million multiplied with 3 deals, multiplied with 4 areas. So roughly you are looking at $60 million of capital pool. But some CVCs are looking to do growth stage investment as well. You need to take that number also into account. Generally, the ticket size for the growth stage investment will be $10 to $15 million. For that kind of a capital, again, a separate pool of around 120 to $180 million will be required. So you look at the other funds which are existing in the market right now, the likes of your Qualcomm Ventures as well as TDK Corporation, which has a $350 million fund. Uh, these numbers are justifiable.
Yeah. What's the typical time horizon? Like, how does it differ from traditional VC
Yeah.
kind of an approach? What timelines or time horizons do the CVCs look at?
Typical VC model will be 8+2 or a 10+2 kind of a model where 8 years is the exact deployment cycle, and then you start harvesting the particular investment in the next 2 years. Or it can be deployed for 10 years and then you harvest for the next couple of years. So that's a typical VC timeline. But when it comes to a corporate which has done these balance sheet investments, they would be ideally looking at a more patient approach in this scenario. I'll take an example from again InfoEdge. If I recall, InfoEdge put in their early stage money into Zomato in 2007 and 2008. If there had been a fund, they would have tried to exit into 2017, and 2017 was not the best period for Zomato as an enterprise. They may not have been able to realize the kind of cash exit which they have got in 2024. So sometimes CVCs have that upper edge of getting access to multiples on their capital deployed because they are more patient, and it's a rolling pool of capital because the money eventually will go back to the shareholders at the corporate level. So depending on those scenarios, the timelines can be a bit longer and you can realize better returns, at least from an investment perspective.
Thanks, Sanket. I'll move to the questions from the audience, as we are receiving quite a few of them. So let me see. First one, which CVC in India invests in mining sector startups? Equipment to dewater, inverted leaching, and recovery of metal. Uh, yeah.
So, from a mining sector perspective, you should connect with Mr. Amitesh Sinha. He's the head of corporate venture capital for India markets at Vedanta. He's
Great.
also based in Bangalore. You should be easily accessible, at least over LinkedIn. Now looking at the equipment manufacturing, right now, Volvo has a construction equipment team in India. I'm not sure of the presence of their VC arm in India, but their global corporate team would definitely be accessible. Volvo is another option. Then second is Caterpillar. Caterpillar will also be accessible at least on the equipment front. And then there are few players from the Japanese market, Mitsubishi, where you should check out their CVC arm. There is also a dedicated fund called MUFG. I'm not sure whether they have access to the construction equipment as a thesis.
Sure. Next one. What do these CVCs look for? Or what are the CVCs that look for deep tech research-based startups in climate tech and sustainability? Of course, I think Cummins is also one of them, but are there other examples that you can also highlight?
From a deep tech perspective, there are good number of CVCs which are existing way before Cummins entered the market. Shell Ventures, you have recently seen the launch of Schneider Electric. Then we have the likes of L&T Innovation Fund. These guys are already looking at the deep tech ecosystem more closely. And from an evaluation perspective, it's a typical venture capital fund sort of a model where they are looking at uh, product market fit, the revenue, the number of pilots which a particular startup would have done, any form of IP and patents which are bearing any competitive advantage for the startup. Last bit would be about how much easier they will be able to integrate with the business or the core product for that CVC going forward. And lastly, one would be looking at the typical stage of the cap table. Sometimes the cap table is a bit screwed up for the startups where they would have taken a lot of money from the angels, and because of the family and friend wrong, the sometimes the cap table is not that clean for an investor to enter at a Series A and Series B kind of a stage. So one should be very cognizant of the fact that having a good cap table is also an attractive point for an investor, especially the corporate investor, to enter.
Yeah. Um, well, you I think clearly mentioned that there are different stages where CVCs do come in, depending on how they are structured. Some of them come in at Most of them come in at, let's say a slightly at a later stage, but also there are CVCs that work on early stage deals also. Um, so, what are the CVCs that are mostly focusing on the early stage, especially let's say considering climate tech? I think you mentioned Shell E4. Are there others also that are focusing specifically on early stage deals?
Yes, on the early stage deals, definitely Cummins is also looking at that space only. Then there are a few global VCs which you should take a note of. One will be your TDK Ventures. They are again based in Bangalore. Then we have the likes of a few healthcare focused CVCs which are based in EU. So depending on the sector which you are focusing on, I can cite a few resources. You should check out the Global Venture Corporate Venturing website, GCV website. A number of these CVCs are listed by sector. That will be more helpful for you to figure out the right partner for you, at least from a sector. Because one should understand that a CVC is limited by the number of areas which one would be focusing on. Like for me, it is a focus on automotive and energy. For TDK, it will be a focus around material sciences. Then the Qualcomm will be focusing on the mobile-based applications. So it all depends on the nature of the CVC as well.
Sure, I think that answers a couple of the other questions where people are asking, is there a database or is there a website where
Yeah,
people
Global
can see?
Corporate Venturing, GCV. You should check out. They recently did a summit in US, and a number of CVCs had attended that in US. So it should provide you with a good amount of information.
Sure. I think we'll type that out in the chat. It's called Global Corporate Venturing, which the audience can refer to as well. So the next question is, well, you mentioned, I mean, it's not just financial capital, right, that the CVCs provide, but there's also a certain bit of mentorship that go into it. Also making sure that there are the market connects, the go-to-market plans that, the corporates can help directly with. But the question here is, how much time do the corporates also have to provide these kind of guidances to the startups? Is there a dedicated team who completely focus on guiding the startups along the way, or how do you do it?
Uh, Most of the times, a CVC, when they are initially carved out, they hire out professionals with an investment background or an innovation background. They more or less act as the engagement managers when it comes to building those relations and also keeping those leads as warm within the ecosystem. So the full-time employees which are working on this day in and day out, they would at least be dedicating close to 5 to 6 hours, at least on a weekly basis, to engage with the startups, at least the ones which are already working with them. And for the ones which are more or less working in a corporate function plus doing it on a sidekick, they would have a lower threshold of time period. I would not like to cite a direct name, but there's a major OEM brand in India which does the car manufacturing. They have a specific innovation fund as well. So they have a dedicated set of folks who are doing this as a part of their regular activity. They spend good amount of time on a weekly basis, way beyond 5 to 6 hours, while engaging with the startups. Their numbers will go into double-digit number of man hours on a weekly basis. So it depends on the flexibility of the innovation professional plus also the workload, how they do it. For me, it will be an average figure of around 7 to 8 hours on a weekly basis while you engage with startups on premise as well as off premise, where you attend a lot of events as well. That's why you see a number of CVCs getting active, at least in a lot of these startup pitch competitions, pitchathons, as well as events which a lot of these IIT research parks are organizing these days.
Yeah. So I think we have time for one last question. So we'll take that. So this is from Vishwesh. He says, "Hi, my startup works in cooling space and is a deep tech with a retrofit IoT for existing ACs. We are in pre-revenue stage. Can you suggest any CVC? We save 50% energy consumption."
Uh, Typically, for the process industry companies, they would be a large beneficiary of your IoT-enabled devices. Secondly, in addition to the CVC, I would like to suggest Vedanta is actually a right beneficiary. I'll also check internally for my own consumption. But secondly, Vedanta, Mr. Amitesh Sinha will be the right partner here. I would also suggest you should check out CI resources as well. CI has a center of digital transformation and center for startup innovation as well, running out of Delhi. They showcase these kind of IoT enabled products to a number of major corporates. And there is a mandate which these corporates are giving out to CI. So you should check both these resources while you figure out the right partner for yourself.
Great. Thanks a lot, Ankit. I think that's the time we had today. Thanks to all the audience members for submitting their questions to us. If there are any questions unanswered, we'll get back to you separately on them. But again, thanks all for joining, and thank you so much, Ankit, for your time today and sharing all those insights for CVCs.
Sure. Thank you. Thank you, Partha. Thank
Thanks.
you, team at Venture Now.
Thank you. Bye.
Thank you so much.
Thank you.